TheoTrade. This is Don Kaufman. It's November 11th, 2022, and you are watching the TheoTrade Weekend Update. Is a market bottom in? Of course, that's going to be the topic of conversation here on this weekend update. But before we dig too deeply into the marketplace, there have been a tremendous number of questions regarding a brand new segment that we've added to these weekend updates. It's called Get Your Trade On. This week's profits and losses. Of course, during that segment, each and every week, we discuss many of the trades that we provide here at TheoTrade. I mean, everything from in-out spreads to out-of-the-money spreads to high probability trades to hedging activity, you name it, even the flyby, which is a 1-3-2 ratio butterfly. Cover it all inside of this new segment called Get Your Trade On. Nevertheless, with all of those questions, I've decided to put together a 24-week inner circle income accelerator virtual mastermind. Again, it is 24 weeks. Of course, I will be the instructor for that. These are sessions that are going to be highly guided education, but it's much more than that. We're going to give you the trading skills needed to thrive within extreme market environments. You're going to learn through detailed insights guiding you through the first half of 2023. Think about that for a second, because I'm going to be 24 weeks, okay? All of my trades are going to be in there. You're going to be able to follow along and execute some of the trade ideas. You're also going to be able to have the opportunity to come back and forth in terms of Q&A, and that will actually be live. You're going to discover new spread types during this 24-week session, and that is going to be one of those is going to be what we term the catapult, which I think you guys will really enjoy. The catapult, we're going to teach you to basically build a better trader. I mean, one of the things we do over the 24-week period is really look in depth of how do we build a more effective, more structured trader. Find also why long short portfolios are going to be a necessity literally in the coming years. And that means you're not always going to be able to be long the marketplace anymore. Again, it's 24 weeks of guided trading education. You get all of your questions answered, whether it's live, whether it's email. And in addition to this, we have a first time ever bonus. So each year here at TheoTrade, we host a live event. In 2023, well, our live event is coming back. So the entire dream team here at TheoTrade will be doing a live event. Okay, date and time to be determined. Nevertheless, we are giving a free ticket. Again, it is a free ticket to the live event. If you can't make it to the live event, we will allow you to stream, okay, that live event into the comfort of your home. The entire package, including the live event, is $3,000. Again, that includes the free ticket to TheoTrade's 2023 live event, okay, or you can stream that live event. Go now to TheoTrade.com, TheoTrade.com/inner circle, TheoTrade.com/inner circle. The price of $3,000 goes up on November 28th. With that, let's get to it. Let's take a little look at the marketplace and, of course, jump into this weekend's update. All right, so let's get down to business here on this weekend's update. Try to answer the question, is a market bottom in? Well, first and foremost, the rip, the rally, we are so very out of the box. Look first and foremost at the SPX along with me, because I think the SPX, it really does it justice of how significant of a move that we actually saw, of course, on the CPI numbers. Now, again, you know, when I'm talking about CPI and so forth, it's really very backward looking. And what I'm going to try to provide to you, of course, in these weekend updates is, well, as forward looking as we possibly can be. But it's critically important when you see a rip like this, you know, outside, like, look, we started the week, all right? And again, I just want to highlight this where we started the week right in the neighborhood here of 3770. We're going to end the week somewhere just shy of maybe 4,000, maybe at 4,000 inside of the SPX. So, you know, hey, what's 230 points amongst friends? But one of the points that I want to make, and this is where, you know, and why I want to mention a little bit of, you know, backward looking data. People, look at the SPX and the number of breaches. And I'm not even going to go over the whole year. It's just, it would take forever. But look at this. Breach, okay? I mean, breach, 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 Okay, there's a breach over here, breach, breach. It just does not stop the number of breaches that we've had. And the reason I'm pointing this out, and again, it looks like, the SPX has some type of a disease on here. The reason I'm pointing this out is, you do realize what these three lines are. Those three lines are just a distribution curve. You're supposed to stay inside, okay, of those three lines. You're supposed to stay inside that 68% of the time. Okay, just kind of skirt around this and say like, hey, look, we're actually trading outside the expected move about 70% of the time. It's that wild. And it displays that, the markets are still very much in, they're in chaos. Okay. And to say anything other than they're in chaos, okay, is just not, really reality. So you see this incredible and explosive move higher inside of the SPX, which ultimately does cause volatility to subside to a degree, which we're going to look at here momentarily. But one of the big points to be made is, I've been talking incessantly about this volatility box. I mean, last week's video was all predicated on the vol box, how strong that volatility box happens to be. So this is a 180-day 4-hour, okay, and I want to give you a little bit of, again, a little insight to the vol box, and maybe this is the last time we'll have to mention it for a while, unless of course we drop back into the volatility box. But nevertheless, here we are. The volatility box, okay, came into play right back here, and it really kind of resonated from about 3,600 to about 3,800. So what you basically had is this tremendous amount of open interest accumulating in the volatility box because of all the open interest here inside of the S&Ps and the SPX. What happened is CPI comes out, and CPI was the perfect catalyst. And you have to think about CPI as nothing more, and this is one of the important concepts. It's nothing more than throwing a match into a pool of gasoline. So what happens? We, throw that match in there, and we ignite, and we just rip to the upside. One of the things, though, that I think is critical to understand in this particular context is that you had no idea what the CPI was going to be. So we came out and, CPI, it was supposed to be 6.5%, and it came in slightly under at 6.3%. We exploded. Can you imagine? Okay, if the opposite was true, if we came in at 6.7%, what the market would have done. But the point to be made of this, okay, catalysts like this are nothing more, okay, than a coin flip. Again, you threw a match to a pool of gasoline of a marketplace. We exploded to the upside. All right, it was just as easy. We could have actually taken off to the downside. At this point in time, though, we do have quite a bit of gamma risk behind us. And what that basically amounts to is, this move, this trend could actually continue. Now, big question, can we actually make it all the way back to 42.11? There's a lot of other catalysts that can actually hit the marketplace here in the next, few weeks that could really, really dampen down your spirits here. One of which is probably going to be some of the holiday sales. That is still going to be, though, you're a couple of weeks away. You're about 3 weeks away before you really start to dig into holiday sales and so forth. And then, of course, we got another Fed meeting, and it goes on and on and on. But the aspects now that are really going to resonate with this marketplace, obviously the CPI print is going to continue to be incredibly, incredibly important, right? Especially if the market rally is going to have some legs. Like, does this thing really have legs to the upside? And part of the answer to that is going to be found in some of the other catalysts that are going to come out. But you're also going to see, a shift in data. We're going to start looking at things like the jobs number again. Right? Jobs is going to be absolutely critical because along with inflation, like possibly decreasing, but are the jobs starting to get hit? Like, and then GDP is going to be a huge one coming up. So you're going to have to think about GDP. So every economic data point that comes out, all right, is going to be really pulled into perspective. But now the emphasis not only is going to be CPI, again, it's going to be the jobs number, that's the employment situation, and of course it's going to be GDP, because are we going into a recession? So what turned into a rip and rally could turn right around. Again, to answer the question though, does this rally have legs? That 42.11 has actually been another channel that we've seen. And the channel literally goes from, okay, let me just clean this up a little bit so you guys can see it, but we go from 39.31 right up to the 42.11. And we've actually seen this marketplace pinging back and forth between 42.11 and 39.31 a number of times. Does that mean we really have another 200 points to the upside? Okay, do not discount that. Just don't discount it. Now, there is one other, okay, concept in here that I do want to cover, and that is trashed tech is what actually rallied. Like if you look at the rally, it was again, the rally was really, really broad based. But I want to make a quick point with some of the rally, and that's with stocks like Apple. And you can obviously argue that, well, no, Apple, it rallied absolutely phenomenally. Look, it was down, 25%. Now it's only down 17%. But then you start looking at things that were completely annihilated, trashed. Obviously, Meta had some news. I want to push that one aside, but look at products like Nvidia. Okay, Nvidia. This thing again was down 54%. Okay, an just explosive rally off of it. But when you start looking around, and again, what is quote unquote trashed, I mean really trashed stuff like Amazon. Okay, some of these stocks actually rallied the hardest in the midst of the actual boom to the upside, and that actually kind of begs the question of why are they buying trash? It has a lot to do with statistical arbitrage, and for the most part, buying the weakest of the bunch in there. Okay, nothing more, nothing less. There's a lot of gamma behind that. And it makes sense to actually buy, okay, the most trash stocks, but they're not buying them because they're like, wow, Amazon's a really good deal. It has nothing to do with that. Okay, it has to do with a dispersion tactic between something like Amazon and the S&Ps, and that's a little bit deep further, obviously, for this conversation. It's one of the reasons I was talking a little bit about, that inner circle earlier on, because dispersion tactics like this are exactly what like trades like the catapult are designed to take advantage of. Nevertheless, big rallies in really trashed tech, it doesn't sit well with me. It doesn't sit well with me because, again, it's about this dispersion tactic that lots of trading firms use. Now, there is one very also interesting thing that, again, doesn't leave me with a warm, fuzzy feeling, and has a lot to do with the financials. Okay, so if you take a look at the financials, and I'll put them on a year-to-date, so they're only down now about 9% year-to-date basis. By the way, one of my bigger bearish positions. I don't mind saying that. I'm bearish in the financials. It's a longer duration position, meaning that I am bearish in the financials. I am carrying negative deltas in the XLF. I'm actually short about 1,200 shares of the XLF. Okay, I've had some good, some bad, some ugly in this, but so I'm short 1,200 shares, and I'm officially down now by 2%. And you're like, oh, that's horrific. Listen, this is an investment for me. It's an investment to the downside. I know that sounds unusual. But one of the other things I was just talking about a moment ago is you're going to have to be long short to be surviving, okay, for the next, I don't know, couple of years, maybe 5 years in here. And that's all I can see at this point. But the point of me actually bringing this up, well, simply this. If you look at auto expected moves, I mean, the financials, just a phenomenal move. But they didn't really sell off at all recently like tech did. And the reason I'm surprised by this, and again, I'm a little bit perturbed, it's because the interest rate absolutely imploded yesterday. Isn't rates down, interest rate down? Shouldn't that be a negative for financials? Once again, the entire marketplace got caught up in a gamma squeeze. And it's critical to understand that because this doesn't actually bode well necessarily for the rally. Now, the rally could really start to perpetuate itself now that we've kind of stabilized a little bit. But you got to be careful with this notion that all of a sudden, okay, you realize that the interest rate fell dramatically in yesterday's trade. Didn't matter for financials. And financials are, the argument was interest rates are going up. That's why financials are going up. Yeah. Well, interest rates got crushed yesterday and financials still went up. So go figure. It actually brings into question, does this rally have legs? And again, we keep wrapping back over to that. Now, again, financials ripped on a dramatically lower interest rates really, really bothers me. It kind of tells me that the move was nothing more than a manic explosion to the upside, and that's it. Again, now is the time to start questioning like if that rally is really going to grip hold into the future. And we'll know more, obviously, coming into this next week of trade. As I said, okay, the key point to be taken from here isn't, okay, the 39.31. It's if we start to project just a bit higher, I think we've got 42.11 in us. But the question, okay, early in next week, if we fall back down to 39.31, you got to be careful at that point because we slip anything below 39.31, rally is over. And again, I want to be with these forward-looking statements, but at the same time, understand that I am extremely binary okay, in here, meaning that you're still in a really precarious amount of volatility. You're still in this, markets are completely destabilized. And if you don't believe, me in terms of like markets are destabilized, that's when you look back at the SPX and you look at the expected moves. They're completely like, out of whack. Like this is nuts in terms of expected move, and it's manic, right? So to provide, one-sided, trade over here is not effective at all. Listen, if we just start to trickle a little higher, all of a sudden, boom, you're at 42.11 in no time. But if you slip back, if you do slip back into the 39.31 and a little bit below it, it's over, and that's rally over, okay? So be very, very careful at this particular juncture. It's okay to play some positions, but what you want to be able to do with positions like this, either number one, you're selling way out of the money premium, okay? You could sell way out of the money premium. I was selling like, I sold some 4,600, okay? Well, here, you want to see some of the positions, all right? I actually sold way out of the money stuff, okay? Way out into the future, as I like to do ultimate trades, okay? But I was out here selling premium. That's all the way at like the 40. Look at this, the 46.50s. That's one of the things you can do, right? So you can sell all the way up here at the 46.50s. We get back there and I'm like, bring the pain. Anyway, I'm selling stuff that's still 650 handles out of the money. But at the exact same time I'm saying that, okay, I'm also taking a couple of shots, which I'm going to show you here in a moment. All right, so financials over and done with. I just wanted to show that how financials ripping doesn't make a whole lot of sense with interest rates going down. Again, it doesn't make you feel warm and fuzzy, okay? That number one, the financials ripped on lower interest rates. Number two, trash rallied. Trash rallied, okay? And when trash rallies, you have to think like, it's more about trading in gamma than it is about nobody's coming in here and be like, oh, I really need to buy me some Amazon, or oh, I really need to buy some Meta. Okay, oh, that Nvidia is looking like a good buy right now. All right, onward and upward. One thing I'm also going to give to the rally, that dollar move is impressive. Has the dollar been completely taken out of the equation at this point? Meaning that the dollar rallying, and I've talked about this extensively, the dollar rallying to me was indicative of like, it's like the new VIX. All of a sudden though, the dollar gets crushed down. I'm kind of wondering to myself, is the dollar just over and done with? That the dollar's not going to play into this? That the S&Ps are going to decouple from this dollar trade, and that was dollar up, S&Ps down. The dollar rally has been phenomenal. Again, this is another one you got to watch very, very carefully earlier into the week. If the dollar continues down and then you see the S&Ps go down, okay, then all of a sudden you just have to almost negate some of the dollar trade. I'll give you more on that mid next week. Mid next week, I'll have some more clarity in terms of the dollar trade. But again, the dollar move is just downright impressive to me. And with that dollar move, okay, and this is, again, it's so ironic to see this. Gold. Gold is, it's your inflationary hedge, except in inflation. Okay, now the question is, has inflation peaked? Now gold is finally rallying. Gold really isn't rallying. Okay, well, it is going up, but it's really more or less that the dollar is getting crushed and actually forcing some of the commodity products a little higher, including none other than like, oil today, which, as soon as you actually see the dollar getting crushed, you start to think, well, is oil going to explode back to $100? Because if it does, then I guess inflation is very much here. You got to love the irony over there. Okay, this is it's a no-win situation. Okay, so let's take a little gander over at bonds also in volatility. So bonds exploded back to the upside. But the bonds, okay, with all due respect, this too was an impressive move yesterday. Now the bonds here on Veterans Day are officially closed. Now the electronic bond market, the bond futures contracts are open, but the cash bond market is actually closed today. Hence, we don't see much of a move. Nevertheless, we're still only about 3-4 points away in the bonds from a really scary place. So again, a little bit more information is going to be needed. If the bonds start to creep even up mildly to like 126, I think at that point, again, the bond trade decouples a little bit from the S&Ps as well. Again, everything, that you're seeing on the screen right now, right here, right now, looks to be, well, the S&Ps are going to be bullish. Well, newsflash, the S&Ps are bullish, right? You get the dollar getting crushed, you get the bonds, okay, the bonds that have rallied huge. Volatility is actually doing what? Volatility has come down dramatically, but with all due respect, if you look at volatility, by the way, that's the maximum volatility chart. Look where vol is, okay? It's still, and I'm just going to zoom into like the last, couple of decades over here, vol is still at that 22 handle. which is still relatively high versus the previous, well, in this case, you have almost 20 years of data on the screen. And the reason I make that point is, don't take off your volatility hat just yet. I mean, effectively, you're seeing some volatility to the upside in this. So bonds and volatility at this point also kind of, if you will, push towards that much more bullish connotation for the marketplace. But then again, I mean, this is a market of just, it's so bifurcated right now. On one hand, I'm looking at it and I'm like, do we have, does this rally have legs? And then, trash rallied, and then the financials ripped on lower rates, but the dollar move is impressive. That's really bullish for the S&Ps. And then, bonds and volatility both look bullish. But then that question comes in there, the crypto crush. Okay, listen, I don't spend a huge amount of time, okay, here at TheoTrade talking crypto. Okay, I don't. But this is one that it really started to bother me in the last like 24 hours. The more I think about this, the more disturbed I am. Okay, so everybody for the most part has read a little bit about obviously the exchange based out of the Bahamas. Okay, FTX that goes up ultimately in flames. That isn't necessarily what bothers me. Okay, what bothers me is the investors in that particular exchange. Okay, who are the investors? One of them was actually Sequoia, and Sequoia is supposedly one of the smartest, firms on the street in terms of venture capital. Sequoia, by the way, has been behind some of the biggest IPOs, and you have to start to think, okay, a little bit deeper. How many more of these incidents are actually out there? If they miss this, okay, what else have they actually missed in this marketplace? And by the way, it wasn't just Sequoia. There are a number of key investors over here, okay, that are absolutely brilliant firms. Are they just going out there, getting themselves involved ultimately in a Ponzi scheme, and everybody's in on it? And I'm not just referencing right now Bitcoin or crypto, okay? Wouldn't be isolated to that, right? And then again, there's a number of other investors. Well, not Tom Brady, but there's a number of other investors in there. And it really begs the question, how many more of these are we actually going to go through? And I think the answer to that is, and I'm going to give you my feeling on it, a lot. Okay, is the crypto crush contained? It's not what you think. I don't care that crypto is contained. It probably is contained. Okay, what we have right now is a number of products. I mean, you can even look at stuff like Apple. And again, is Apple a Ponzi scheme? Absolutely unequivocally not. Okay, but you look at this, that is still absolutely bubblicious at this particular point in time. And to say otherwise, I think you're, again, diluting yourself to some degree. So there is a number, okay, of, again, hidden dangers to this marketplace that just haven't played out. All you're seeing inside of the crypto market is some, okay, of the weakest links are starting to finally fold. Some of the dominoes are starting to tip over. And when you start to see exposure to the amount of $200 million is what Sequoia had invested, okay, in FTX. If you're not questioning it, okay, you're missing a big picture out there. All right, let's actually jump into the section now. Get your trade on this week's profits and losses. Okay, one of the first things I want to talk about, as I was saying earlier, the good, the bad, and the ugly, Goldman Sachs, okay, getting killed. I'm in a defined risk spread. Now, I just want to show it because if you're going to get killed, this is how you do it. You go out, okay, and you buy a $2.50 wide spread. And I have absolutely unequivocally, no problem displaying a trade that has not gone my way because take a look. I'm in this thing for $1.19, okay? Pretty much average price is $1.19 coming into the cash close over here, but $1.19 is pretty much my average price. What's it worth right now? Absolutely nothing. With 7 days left in an outright crash inside of Goldman Sachs for this thing to play out well. I mean, it exploded to the upside. And people are like, why would you ever get short? I got short this because it was crossing outside of the expected move in a multitude of weeks. Okay, you got 1, you got 2, you got 3, you have 4 weeks in a row, 4 weeks in a row. You want to talk about statistically insane? It's right there, 4 weeks in a row that we're actually outside the expected move. Nevertheless, I'd still look for Goldman Sachs to actually pull back. Okay, this is a trade that I might once again reinitiate in this next week. All right, moving on. Let's actually cruise over to one that went our way. Tesla. Okay, what have I done in Tesla? I was bearish. Okay, Tesla did bounce today, but didn't matter. I was already out of the trade. So if you want to take a quick glance over at my Tesla position, I went out and bought a $10 wide out of the money put spread for 240, closed it for 649. It's a home run. So on one side of it, we have Goldman Sachs, which we pretty much bit the dust with defined risk. On the other side, we took 240, turned it into 649. All right. onward and upward. The next trade on the docket here is FXE. If you're unfamiliar with FXE, you get familiar with it. Okay, this was actually a bullish position. And what do we have happen on here? Well, the move that we were looking for. So it paid anywhere from $1.11, $1.15, $1.16. We're able to close this particular spread from 272, 276, even up to 277. Another home run there on an out of the money spread. And well, one of the last ones I really wanted to mention over here was a ZB. Okay, the ZB is a little bit wild. I place a lot of different trades inside of the ZB, but these 115 puts, just wanted to highlight this. I sold them for 18 ticks, bought them back for 2 ticks. So in terms of premium selling, you don't always make a lot of money in premium selling, but wow, okay, the probability of profitability is incredibly high. So another profitable trade in there. Now, a couple of new ideas that I am going to present to you. All right, VIX, IBM, and SPX. So real quick over here, if you take a look at VIX, it's a time like this that I'm going to be looking to buy VIX call spreads. Not necessarily just because I think the VIX is going to explode. I think that that's, it's tough to actually, guide into that. But if you need a hedge, so some of the VIX call spreads don't go out much more than about 39 days in those VIX call spreads. All right, much more on that trade throughout the course here at TheoTrade, of course, throughout the course of the week. All right, IBM. If I cruise over to IBM, in terms of IBM, look at this, 70 days out buying a put spread in IBM. Why? And it is over for the week in IBM. IBM has had one of the most explosive moves. This is actually not dissimilar to the Goldman Sachs position, but take a look at auto expected moves. Again, auto expected moves. In terms of auto expected moves, explosive move to the upside, explosive move, right? This week, okay, null, explosive move to the upside. So effectively, what we have is coming out of the earnings, we have 3 out of the last 4 weeks, 3 out of the last 4 weeks that have actually smashed through the upper edge of the expected move. I don't know about you, but I like it. So I'm actually going to take a shot, and it's a very controlled shot. When I say a controlled shot, I'm going to go out there, define my risk. I paid anywhere from $1.84 to $1.50. Okay, it's probably worth even less than that now as IBM continues. Okay, it's staged to the upside, but I'm 70 days out. Last one on the docket this week, of course, is SPX. Okay, in terms of SPX, all right, what am I doing in SPX? Very similar to what I was doing inside of IBM, very similar to what I was doing inside of Tesla and the FXC. This is an out-of-the-money put spread in this particular case. Now, when it comes down to it, all right, and you look at SPX, another break to the upside following its earnings announcement. That's fine. Right? It's right where we want it to be. Okay. If we actually pull back and take a look at the strikes, okay, look at the strikes. This is the 85.75, 85.75. So what do we really need to have happen? Take a look, of course, at SPX, 85.75. We get all the way down here. Okay. Right back down here will be gold. Of course, we have between now and January expiration. One thing I also want to mention, these trades, whether it's VIX, whether it's IBM, whether it's SPX, these are out of the money spreads. We're going to go out and we're going to finance those out of the money spreads by having sold premium to do so. So don't think I'm just taking out of the money shots. Oh, I absolutely am taking out of the money shots, but I'm going to finance those shots having sold other premium. And that's actually what we term a catapult spread. Last, but definitely not least here on the weekend update. Look, this week, okay, we got to cruise back to the SPX and just discuss it for a moment. We had an earth-shattering move this week to the upside. Again, we broke through the volatility box, exploded to the upside, right? The upper edge, okay, of the expected move. And I just want to highlight this. The upper edge was 38.88. 38.88. Where did we end the week? 100 plus points beyond. Okay, that again, it's almost a 2 sigma move inside of the SPX. This next week, so you have this move and it's like 200 and some odd points, okay, on the week. What's next week looking like? So we have a primary expiration week coming up, November 18th, the PM settlement. Look at this. They've crushed the volatility down to $98. So last week was about $117 expected move. You're telling me, okay, that in this next week of trade, we only have about a $98 expected move. People, okay, listen, that is low versus some of the price action we've seen in the SPX lately. Do not sell short-dated options in the S&Ps. With that, again, we're going to end right at the 4,000 level for the week. Remember what I said about, again, 42.11 and the 39.31. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.